We're going to discuss the UTP 2040 here in detail. UTP 2040 is a hyper scalp strategy that is a part of your Ultimate Traders Package membership that many of you may not be aware of. So what I want to do is I want to make a lot of you or most of you aware of it so that you can use this if in fact you decide that you're looking for a consistent way to be able to participate, which puts you at very, very little exposure. All right, so let's discuss that here. I want you to feel free, of course, to ask any questions as we go along. If something doesn't make sense, please feel free to indicate that in the chat box. We'll discuss it in as great detail as I possibly can. Before we begin, does anyone have a specific currency pair that they would like to see this on? All right, first come, first serve. If you have a currency pair you'd like to discuss this on, please go ahead and type that into the chat box. All right, and we'll work with that. Strategy is meant to be used on a 10 or a 15-minute chart. Okay, EuroCAD. All right, EuroCAD it is. So let's go ahead, let's open up a chart. I'm going to go to charting, new chart. It's going to be a EuroCAD. Again, as I mentioned, this is going to be dedicated to the 10-minute chart. You can use a 15-minute chart if you don't have access to a 10-minute chart. But ideally, we want to be looking at a 10-minute chart. All right, so I've got some entries in this right now. I forgot all about that. So that, just try to pay that no mind if you would. Actually, one second. Settings. See if I can turn this off. Show price alerts to show indicator names. No, I can't seem to turn that off. Trade settings. Show open orders. There we go. And pending orders. We'll turn that off for now. All right, and I'll put that back on later. I just don't want it to be distracting. There we go. Okay, so for the Rick has audio issues. Rick, we have begun. Please make sure that your computer audio is turned up or that your audio option on your control panel is set to what you want it to be. Okay. Now, the UTP 2040 is something that you have access to inside your indicator section, right? So if you go to your indicators, we go over here to the indicator section on the left-hand side of the chart. We click on that, we're going to be presented with multiple options here. The UTP 2040 is inside your custom indicator section, and it is part of your Ultimate Traders Package membership, as we discussed before. So if we double click to reveal on the contents there, I may have a lot more indicators in here than most people, right? And that's because I'm an analyst and I have to have all this extra crap for all the additional courses so that I can teach it, right? So if you don't have all this stuff in there, that's okay. Don't panic. It's just because you're looking at an analyst computer. All right? So what we're going to be looking for is for the UTP 2040, or it may be listed as a TUTP 2040. Okay? And in order to activate this, I'm going to double click on it, and what that's going to do is it's going to move it over here to the center column, or you can click on the right arrow. Whichever the case may be, we're going to be moving it over to the right hand side. Okay? Once we've done that, you'll notice there's nothing here on the right hand column. That's because this is a locked system. We can't make any changes to it, so nothing is going to pop up over here. But when we click on OK, we should now see the lines pop up on the chart. Right? Anybody having any issues popping this on their chart? This is the UTP 2040. All right, George is good to go. Good. Okay, so in general, no issues being reported in the chat box. Excellent. All right, so if that's the case, then let's go ahead and let's zoom in here and let's see what this is all about, because right now it doesn't look like much of anything. We're going to take a look here, and as we get closer and closer, we start to see a little bit more, right? And again, this is meant to be a hyper scalp strategy. Your typical scalp trader is looking for an entry opportunity where they're risking no more than 75 pips and they're not looking to be involved for more than a single day. So this is actually hyper scalp, which means you're looking at an even smaller risk than that. The purpose of this strategy is to allow you to be able to participate in multiple positions during the course of a single day and be able to not have to marry a particular direction. So you can actually participate in buy and sells throughout the duration of a trend. But if the market should trend for a prolonged amount of time, you can ride that as well. All right? It's just designed to help you be able to get onto first base every time. All right? So here's how this goes. The first thing that we need to be able to interpret is the trend direction or market bias. And that's going to be determined based on our trend lines. So if I were to take a look at this market right here, where would you say this market was going here? Was it making higher highs or lower lows when this was the trend? Yeah, absolutely. It's making lower lows, right? Lower lows, lower highs, lower lows, lower highs. So if I were to identify this with trend lines, actual trend lines, I draw an outer trend line, right? And provided that I had the opportunity, I would be able to draw an inner trend line as well, right, if need be. Maybe when this was the actual trend, you had a really aggressive inner trend line right here, and that trend line broke, the market moved slightly further, and then slightly further as the market gave lower lows, we had to adjust the inner trend line until eventually we had none. But we know that we can draw our trend lines depending on the aggressiveness of the volatility of the market. We can have an outer trend line, we can have an inner trend line, yes? So that's exactly what the UTP 2040 does. Our thin outer trend lines, okay, this thin black line and this thin red line, these are the trend lines, or the ones that determine market bias. If your if your candles are below both of those lines, all of this below, okay, if your market is below those lines, you are in a sell mentality. Okay, this is decisively below both of those lines. Here's the black and the red line, decisively below them. If the market were to get decisively above both of those lines, you are now in a buy mentality. Can everybody see that? Okay, in between is kind of a murky area, and we'll explain that a little bit later on. But for now, to determine market bias, we're looking for the market to be either above both the red and black lines or below both the red and black lines. And we are only looking to take entries in that direction based on the bias. So if it's above both the lines, we're in a bullish bias, we're only looking to buy. If it's below both of the lines, we're in a bearish bias, we're only looking to sell. Is that clear? Any questions on that? Okay. So the next steps is to be able to determine entry. So in order to be able to determine entry, what we're looking for is for the rest of these lines, the blue, the green, and the orange to agree with the market direction. And we're looking for the blue, the green, and the orange to agree with the market direction. We want at least 2 out of the 3 to be crossing before we can consider that an entry. If you can get all 3, that's even better. It's just more confirmation. All right, but we want at least 2 out of the 3 for an aggressive entry. Any questions? All right, so here's an example of the market. Right here with this candle, we are decisively above both the red and the black lines. This candle is closing above. And what I want, take a look at you see how these have not yet crossed below? Okay, I want to have at least 2 out of the 3. So I want to see kind of a, okay, here's a change in direction. Right? This is a murky area, but if you can see this, right, now all 3 of them are above. See kind of the dip here? All 3 of them are above. Not the clearest example, but I want as much as I can to agree. Right? They're definitely above the red and the black lines. So if I was really, really, really aggressive, technically right here when the market had closed above, and I still had technically 2 of the 3 lines above, I would technically have had an entry if I was really, really, really aggressive. Personally, this wouldn't have sat right with me. Okay, I probably would have waited for all 3 of them to join, just considering. Does that make sense? So in this situation right here, let me show you a downward. Right, here's the market decisively above, right? We're above the red and the black lines of the buy mentality. Then we get this bearish candle that breaks below both of them. Right? So this is now changing the bias to a sell bias. Right? So if I was to look for an entry though, I can't actually get in until I see 2 of these lines. Here's one, here's the blue one, crossing below both the red and the black lines. It's not until I get 2 or more that I'm thinking about entering. Right? So still can't do it. Here I can. Here is 2 of the lines, both the blue and the green, having crossed below the red and black. Everybody see that? Any questions on that? Okay, so let's say that this was something that I was monitoring, right? Here the market, once again, slow-mo, the market is breaking below with this bearish candle breaking and closing below the red and the black lines, which means that my bias is now to look to sell the market. Okay, my bias is now bearish. But I cannot actually enter into the trade until I see the crosses of 2 or more lines. So here I have the cross of 2 or more lines. This would actually be the beginning of an entry right here. So I'll put a line, a green line right here, so everyone knows I'm getting ready to enter into a position. This is a bearish candle, so I would enter at the close. I'd have to wait for this candle to close naturally before I got the lines to appear. At the close of this candle, this is a closed candlestick formation. It's not going to change. I can look to place my entry into this market at the close of this candle. Close of a bearish candlestick formation is at a low. Lower price than it opened. All right? So I get the close and I look to place my entry at the close of the candle. My stop loss, because I never, ever, 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 ever trade without a stop loss. My stop loss is placed 30 pips away. No more than 30 pips. Stop loss is not to exceed 30 pips. Okay? So I'm right here at 69. That means I'm going to put my stop loss up at 99. Make sense? Anyone not following this so far? Usually you'll find that your stop loss is well past your inner and outer trend lines. George says, so basically the closer or tighter the 3 lines are together to the black and the 3 red lines side would be the side to call. No. No. If the market is trending, okay, as long as the market is above, right, in a normal trending situation where you've got your outer and inner trend lines, right, I would say as long as the market remains above these lines, I, as a trader, don't really have anything to worry about because I would expect that the market is going to continue to bounce off of these lines and continue to move in the direction of my trend. If the market should by any chance break my inner trend line, then according to what the Ultimate Traders Package teaches me, most likely it's going to come to my outer trend line and react off that and more than likely continue in the direction of the trend unless it breaks my outer trend line, in which case I'm looking at a potential reversal, right? Okay, so I'm using my red and black lines as my outer and inner trend lines. What I'm looking to determine entry is if the market is above my outer and inner trend lines, that I'm in a buy mentality and I'm simply looking for 2 out of the 3 other lines to kind of jump it on in there and let me know it's okay to buy this market. I'm just looking for 2 out of the 3. If I can get all 3, then that's even better because this is agreement that the market direction or the market oncoming market momentum is in agreement with me that I'm looking to buy that position. All right. So the next step would be the change in direction, if the market manages to get below both my inner and outer trend lines, then what I'm going to be looking for is for those same lines to 2 out of the 3 join me down here and let me know that it's now time to sell the market. Make sense? What am I looking for? Orange. I have to have the cross of at least 2 out of 3 before entering in to the change in direction. It doesn't have to do necessarily with the proximity of the lines. We're just looking for 2 out of the 3 to agree with the market direction. Any questions on this? All right. So right here, right, what I first had is the big black candle closing past inner and outer trend line. See how they're going in the upward direction, both of them? Right? And then it's breaking, shifting directions. So we're now in a sell mentality here. Once we've gotten below these 2 lines, we're now in a sell mentality. But I can't actually jump in selling until I get right here. All I have, when this blue candle formed and closed below, I just have the one blue line that has crossed the red line. But I need at least 2 of these other colored lines to cross below both of them. Right? So right here I just have one blue line crossing one red line. My bias lines have not yet been agreed. Now the blue line has crossed both the bias lines. It's not until I get 2 out of the 3, both the green and the blue have crossed below my bias lines, that I can consider this an entry. And my stop loss will be placed no more than 30 pips away. So I'm always looking at a maximum risk of 30 pips. Not 30 pops. Always looking at a maximum of 30 pips in risk. All right, so nice and tight. What I'm going to look to do is, this stop loss is actually never meant to be hit, just so you know. This is just purely for emergencies. All right, but if it is hit, again, I'm looking at a maximum of a 30 pip risk. This is where your 20 and 40 come in. What I'm looking to do now is, once I have determined my entry price and my stop loss, I'm going to look to place target lines, soft targets, at 20 and 40 pips away. So 20 pips below this will put me at 49. and 20 pips below that will put me at 29. Right? 20 and 40 pips away. So this right here is my plus 20 pip line, and this down here is my plus 40 line. I am absolutely not setting these as limits. If I were to set one of these as a limit, it would have to be my 40 pip line, because I can absolutely not enter into a position risking more than I stand to gain. So I can absolutely not, forbidden, don't do it, set the 20 pip line as a limit. Violates equity management. That is the very thing that we absolutely do not do. Okay? So if I were to set a limit, it would be the 40 pips, but I'm not going to do that either. The premise is that if the market should touch my 20 pip line, okay, I can at this point cancel and replace my stop loss to break even. Okay, I personally am not a break-even trader, so you won't see me doing this. But it is permissible for me to cancel and replace my stop loss to break even. All right? This is going to put me in a situation where I am not looking at any risk anymore, except for the spread that I've already paid. Okay? I am not a break-even trader. I do not like break-even. That's just my personal choice. You can break even if you want to. I don't like that. All right? I know that the market likes to score a point and pull back. So if the market decides to score the point and decides to pull back, I'll be stopped out with nothing to show for it. All right? Chris says, so that would be a risk reward of 1 to 1.33 at 40 pips. Exactly. Exactly. Which is why we're looking to set these up as soft targets. So just effectively, just align on your chart so you know where you stand in relation to that position. Right? Just align on your chart. If and when the market hits your 40 pip line, right, which here came real close but didn't. Okay, that's at 2.9. This came down here to a low of 29.5. Actually, we could say it hit 40 pips. Right? If it were to come down and hit your 40 pips, then you could cancel and replace and lock in 20 pips. Right? You could cancel and replace and lock in 20 pips. So if the market were to turn around and hit this like it did right here, this would have stopped you out positive 20 pips. Right? And you would have been out, been done. So for some traders, this would have been the end right here. Now, for me personally, I'm looking for the opportunity. The premise of this system is that it is aggressive enough to provide you with an entry, but flexible enough that if the market were to continue to trend, I can ride that trend. So my goal is to start this off with the mindset of a scalper, but I can very easily transition into a position. Right? So, remember how we talked about if the market does not break your trend line, your inner and your outer trend line, we don't really have a reason to believe that the market's reversing? The same thing is going to be done here. As long as the market remains in a sell bias, so below the red and the black line, I can realistically hold on to this position. If the market were to break my bias, it is then and only then that I'm looking to close the position. So if you've canceled and replaced and you've been taken out, but my preference is to ride it out. I want to let my profits run. If this market is indeed going to continue to go in the direction of the trend, I want to let the profit run. I want to give the market the ability to do that. Right? See how we came right here and broke the red line? But what the market does, just like the Ultimate Traders Package teaches us, is when the market breaks the inner trend line, it doesn't necessarily mean that it's going to reverse. What it means is it will probably test the outer trend line. And that's exactly what happens. See the market testing the outer trend line? Got a wick that stuck out, but not a decisive break. So we didn't get on the right side of that trend line. We didn't break it, just a test. I want to give this market the opportunity. I want to give my profit the opportunity to run if that's what the market wants to do, right? And it's if and only if, there we go, the market breaks decisively and changes my bias. It's if and only if that happens that I'm looking to close my position. Make sense? My stop loss is actually never meant to be hit. If I'm canceling and replacing, following the market as it goes, right? If the market makes a lower low, cancel and replace my stop loss, cancel and replace my stop loss. I usually won't look to do that though until past 100 pips. Okay? When we're looking at 20 and 40 pips, it's just not a large enough number to merit me scrambling to, ride the market that hard. I understand that I have to give the market some room to breathe. Right? Dwayne, correct. You don't have to put a limit on this. The idea is that if the trend is going to run, we want to be able to run with it. All right, Brian, this is absolutely being recorded. All the webinars for market traders are recorded. All right, Rick, that's correct. Right. In this case, again, for me personally, right, if you're a new trader, it's okay to have some trepidation. All right, and I don't want anybody taking my word on this. Period. Right. I'm teaching you the strategy so that you know what to look for and you have access to this indicator. So what I would expect from a responsible trader is that they will take the time to open up a chart and run through and back test this, looking at the different entries and seeing how it did. Okay. Now, what I also am teaching you to do is you have options depending on what kind of trader you are. If you're a newer trader and your confidence is a little shaky, be it in the strategy or be it in trading or whatever the case may be, if your confidence is a little shaky, then you're going to want to try to protect yourself as much as possible. That's okay. That's teething things. And so you may be very, very interested in canceling and replacing to break even, and maybe even canceling and replacing at 40 pips because you can do that as well. Right? And then every time the market gives you 20 pips, you can lock that in. Right? For me, I've been at this a while, and I understand that the market moves in waves. And every time the market scores a point, what it likes to do is pull back. And it's going to go ahead and score a point, and it's going to go ahead and pull back again. So I like to give the market some room to do what it needs to do. Right? I understand that the system is flexible enough to allow me the ability to run with the trade if it does. And worst case scenario, I also understand that I'm talking about a maximum of 30 pips in risk. And I never enter into a position that the risk exceeds more than 5% of my account. Right? I never enter into a position of that type because that would violate my equity management. So I have all these things that are kind of working in my favor to kind of soothe my brow and not make me worry. As a result of that, I can trade this in a very relaxed form. You'll find that if you follow the rules, you can trade very relaxed as well. All right? So keep that in mind. Chris, just shoot me an email, bud, and I'll get it to you. All right? Rick, that's okay, my friend. I typed a message into the chat box to kind of help you get oriented. Hopefully that helped. We're talking about the UTP 2040. All right. So in this case, again, we had the crossing of the lines. We had the entry here at this green line, this vertical green line, excuse me, that I placed, where we had the potential entry, and then we marked, and right here where the market once again crossed the bias lines, the red and the black lines, would be the close of the position. At this point in time, I would have closed from my entry price, positive here, from my entry price to where the market crossed over the lines at the close right here. I would have been positive about 29.5 pips. So we'll just put 29 pips. All right, at the close of this position, I closed positive 29 pips. Right? Any questions on this? Chris, that's correct. If you want the most confirmation, you can wait for all three to cross. Okay. So now that this market has crossed above both the red and the black lines, we've got a change in bias, yes? Let's zoom in here. I'm going to get rid of all these entry lines. Right, we had a position that took place here. Now our bias has changed, so we should be considering a bullish bias, right? This is where the market broke above both. I only have the blue line crossing both the red and the black. So now my bias has changed to a bullish bias. I should be considering buying this market. When I get across, here I have both the blue and the green line crossing the bias lines, the red and the black lines. So this is potentially an entry for those of us that are a little bit more aggressive. If you are more conservative, you may choose to wait for the third one to cross. Okay? But in this case, 2 is enough for me. So I would consider placing this entry right here at the close of this candle. Make sense? Immediately after the last position closed, this candle closes 10 minutes later, boom, I've got another potential entry opportunity. So my stop loss is going to be placed where? How many pips away? $30 pips max, right? 30 pips max. So my stop loss is going to be down here at 11. Right, this is at 44, so I'm going to go down here to 11. I can't go down far enough, so I'm just going to edit this and actually type it in. I can't go down far enough with this view, but I'll adjust it momentarily. All right. Stop loss will be down at 11, and I'm going 20 and 40 pips to the north. So 20 pips above will put me up at 64. All right. And I've got another soft target at 84. I can't go up high enough here, so I'll just type that in. 84. Okay, so we'll compress this, see the entirety of the setup here. Any questions on this so far? Chris says, I missed the start, but this is better for active zone trading. Chris, that's a great question. When it comes to any kind of entry opportunity, any kind of trading, point blank period is going to be better during the active zone. Doesn't matter what it is. It's going to be better during the active zone for the simple fact that there's more money being exchanged. Right? That's what this is. This is a currency exchange. So the more money there is in the market being moved around, the more opportunity we're going to have, and the faster we're going to be able to make it during the active zone. It just is the nature of the beast. It doesn't matter what strategy you're trading. You're going to have the most opportunity during the European session. Does that mean that I can't use this during any time frame? Any time zone? No. Right? Yeah, Chris says you can also send me money anytime. I'll get right on that. I'll get right on that. But no, seriously, as far as any kind of strategy, you're going to have way more opportunity and indeed more than likely way more success during the active zone. But this particular strategy, since it's so aggressive, you can realistically use it during any time zone. So again, I want to encourage, this is just for the sheer purpose of getting everybody kind of on the same page as far as how to do it. But what I want to encourage everyone to do is to actually look at this, back test it, and you'll see the results for yourself. Right? I don't want anybody taking my word for it. I want people to actively back test this and prove it to themselves whether or not it's worth their time. Right? So in this scenario, I've got my signal. This is the start of another position here. And again, if the market starts to go very sideways here, oh, it's broken the bias. So I'm closing this position. Okay, this went sideways. This is terrible. This is a horrible 40, 50 minutes of my life. The market just does nothing. And then it crosses below once again. This is terrible, 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 terrible. All right? So now I'm looking at, I'm negative, but I didn't take a 30 pip loss here, right? I closed when I see this confirmation, right, of the market crossing below both the red and the black line. So let's zoom in here. Let's take a look at this. All right? Here we are crossing below both the red and the black lines. So I should have closed right here, yes? Which means that I took a massive loss. Okay, I took an absolutely massive loss. It's devastating. I lost 13.6 pips. So let's round up. We're going to be pessimistic. We lost 14 pips here. Okay, 14 pips. I'm devastated. I'm dying. All right. So same situation here. If the market calls for another entry, I have the opportunity to participate. Here's a bullish candlestick formation below. Right. Later on, you can start applying logic to this. A bullish candlestick formation with a sell mindset. Right. But as far as pure back testing, right, we're just going to go for every signal that the market calls. So right here, if this market were to give me 2 out of the 3 lines, right, I'm not going to apply reason to this. I'm just going to blindly follow this. If I get 2 out of the 3, then I'm looking at a potential entry. That still hasn't happened. Okay, and now the market is back above the red and the black lines. Everybody see that? Here's the candle. Here's my red and black lines. And I actually have 1, 2, 3 above. All right? Rick says the green hasn't crossed yet. Yeah, Rick, exactly. Right here, this is where the market actually crossed below both the red and the black lines. That's what caused me to close the previous entry and take that massive loss of 14 pips. And then I was like, okay, well, clearly the system has changed its mind here. So I may have to be looking to sell this market here. But in order for me to sell it, here's still my red and black line. I only have 1 line crossing below. Right? I'm looking for at least the green, at least 2 of them to be in the same section. Here's the next candle. Okay? You see how the green is still above the red and the black? So I have not had the cross. Then the next candle, I get the market going back above both the red and the black lines. And my blue line, which was below, has now joined the rest of them back above. So now I technically have all 3 lines in the buy zone. Does that make sense? So is this an entry? Yes or no? I am absolutely looking at another potential entry. This is a really indecisive candle, right? But again, I'm not applying logic to this. I'm just going by the entries, right? So this could potentially be another entry situation. Right here. Oh, crap. No, I don't want that. Right? Entry. And my stop loss goes 30 pips to the south. So I probably have a line somewhere down there. Okay. This is at 37. I'm going to bring this up to 17. Because my stop loss for that entry would be at 17. And I'm going to go 20 pips and 40 pips. So up 20 pips will put me at 57. And up 40 pips will put me up at 77. All right? So if the market starts to move in my direction, again, I'm going to be looking to capture opportunity. If it doesn't, everybody see what the market did here? Is this a change in bias, ladies and gentlemen? Oh, sorry. Yeah, I'm wrong. Thank you. Thank you for that. It should be, stop loss should be, thank you, Chris, 0.7, not at 17. That's actually way too close. It should be 30 pips. No more than 30 pips, but it should be 30 pips. Right? Between 25 and 30 pips, but that was not 30 pips. Right? So we'll go right here. Worst case scenario. I want worst case scenario always. Thank you, Chris. Right? So we did not break the line. We did not break the bias. So I maintain the position, right? Maintain the position, maintain the position, maintain the position. Market starts to move in my direction. We all like that. Right? Market moves in our direction, pulls back down, still barely positive here, right? Nothing to write home about. The market scores a 20 pip line. For those of you, I appreciate it, Chris. It checks in the mail. For those of you that would like to, or that are a bit more conservative, you may choose to cancel, replace your stop loss. You may put your stop loss at break even, right, when the market hits the 20 pip line. I am not that guy, so I won't be doing that. Right? I do not do break even. Right? The trend continues. Okay, the market scores a point and pulls back. This is why I don't do break even. Okay? At this point in time, what happens? Anybody seeing anything here? Here's an inner trend line break, right? We're not panicking. Here it breaks both, so we close the position right there. Okay? The traders that are paying attention to the trend direction would close positive right here with 7.3 pips. 7 pips. Still nothing to write home about, right? This is the dead zone, but we're positive. All right? We're not applying logic to this. We're just looking at cold hard numbers. We want to see worst case scenario. So I closed here technically positive. I'm paying attention to the trend. 7 pips. All right? Big, trying to write a congratulatory letter to myself. I'm signing myself up for the Nobel Peace Prize, Nobel Trading Prize. I'm getting all of them because I'm just killing it, right? 7 pips. If you, oh, sorry about that. Actually, if you cancel and replace to break even and you're not paying attention, you're going to get stopped out with nothing to show for it. You'll probably be in the hole because you paid for the spread, right? So want to be paying attention to this. For those of you that are, you'll notice the change of bias and you'll be able to change direction. The point is, what you will notice when you start applying logic to this is, when the active zone kicks in and you start looking at 2:53 in the morning, when the active zone kicks in and you start looking at active zone positions and you see the market, you see how this does not come back to break. This isn't, right? Here's the market coming back. If you entered into the sold, you probably got into another crappy situation right here. Maybe even had to close the position, right? Taking another 4 pip loss. And then the active zone kicks in. So here's the market breaking above both the red and the black lines, right? Decisively. And then you get two, actually all three, once again, right there. Okay, so you've got yourself another entry opportunity. You place your stop loss 30 pips below that. Now, this is where you start to see the market really move aggressively. And remember that as long as the market does not break out or break your bias lines, do you see what happens? Here's a test of the outer, and it just continues. As the market continues to do things like this, you continue to hold your position, and only when the market breaks do you close, and you continue to capture bigger and bigger streaks. Just like with anything, you're going to have the highest percentage chance of success or the most opportunity during the active zone, and it does it again and again and again. If you miss the initial cross, ladies and gentlemen, if you miss the initial cross, if the market should come back to test your trend line like this, this is potentially another entry opportunity. If you're in the position and the market comes back to test the trend line, this is potentially an area where you can increase your position by adding another lot to it. Right? Chris, you can, But that's another step of complication, and we're talking about a 10-minute chart. So we're looking at really, really aggressive. If you can, adding the Fibonacci is not going to hurt you. But again, you have to be spatially able to handle it. Right? Realistically, the strategy is designed in such a way that you don't have to do that. But adding Fibonacci is not going to hurt you. Right? So once again, if you get tests of the trend line, and you miss the initial entry, that could be a potential additional entry for you, or a position to add to your entry. Right? So you had your initial position way over here, you add to your entry, add to your entry, and each time the market goes to the trend line, if it doesn't break below, right, you add to your position, you ride the trend. That is the purpose of this strategy, to help you get into first base every time. We're not looking for the home run every single time. We're looking at first base. We're looking for first base every time. But when the home runs take place, this strategy allows you to ride them aggressively enough to take advantage of the entirety of the home run, and always with a starting point of very, very minimum exposure, no more than 30 pips. All right. Rick says, where would you have moved your stop loss? Rick, once I get past 100 pips, I'm going to be following this. Every time the market creates a higher high, I'm going to use the candlestick strategy, right? Just like the Ultimate Traders Package teaches us. So if we get past 100 pips positive, so right here from this entry, I would say this looks like 100 pips. Once I get past 100 pips in the positive, every time the market creates a new higher high, I'm going to cancel and replace the sucker below the last low. I don't want to move that. Let's just, whoop. No. Turn that off. Okay, every time the market moves past that, that's where I was going. I'm going to cancel and replace below the last low. All right, cancel and replace below the last low. When the market gives you a higher high, 2 to the left, 2 to the right, you cancel and replace 10 pips below the last low every time. All right, at this point, this would have stopped me out right there. Boom. All right. Another option, Rick, that some traders use is the dynamic stop loss, which is something that the Ultimate Charting software gives you access to, but it's going to depend on whether or not your broker honors that. Right? A dynamic stop loss is essentially you dictate how many pips behind the current market price you want it to remain. Right? So if it retraces more than that amount, it's going to stop you out, but as the market, let's say the market was here, right? If I say stay behind the market 50 pips, if the market goes up, it's going to stay behind the current market price 50 pips. If the market were to retrace more than that, it'll knock me out. Right? But if the market continues to trend, it's going to stay with it, stay with it, stay with it, stay with it on the way up. All right, so you got a couple options to kind of maintain this. This is on a 10-minute chart, so if you have the opportunity to trade the session or kind of ride out the trend and pay attention to it, I would strongly recommend that. But naturally, we have lives and we have things that we must do. So if you can't do that, dynamic stop losses are a way to go. Or if you can trade via a mobile platform, I'd also recommend that as well. All right. So with this, we're going to come to a close here, ladies and gentlemen, for this webinar. I hope that everyone found this enjoyable, educational. The best part about this is that it's available to you at no extra cost. It's already part of the Ultimate Traders Package. Traders just don't know that it's there. So I take it upon myself to make sure that you are aware of all the tools that you have available to you. Take some time, maybe on a Saturday when the markets are closed, back test this on your preferred currency, 10 or a 15-minute chart. Take a look and see, worst case scenario, are you still positive? If you start talking about adding logic to it by paying attention to when fundamental announcements are taking place, by paying attention to the candlestick formations in the direction of the trend, all of these things that you already know, it only gets better. And what you will find is that even if you are paying attention to just the signals and you enter into this blindly, what you should find is that it's positive. Right? If you start adding in logic to it, it only gets better. So I don't want anybody taking my word on that, though. I want people to make educated trading decisions. This is your money. I'm not trading your money. You're trading your money. Do not take anybody's word on it. Find out. Confirm for yourself. All right, that is the UTP 2040 indicator. All right, so I'll see you all back on Analyst On Demand on forextips.com at 10:30 p.m. for the next discussion. This has been Will Gomez, FX Showtime.